More like a bolt out of the blue, the Reserve Bank of India has set cat amongst the pigeon. First, it was a denial in last two credit policy about inflation and what was happening to the world in terms of how the commodity prices and how things were moving in terms of an uptick. And now there seems to be desperation to simply understand that the red hot inflation, if not controlled now, it could backfire. So Reserve Bank of India, perhaps some would say, has done the obvious, but they've done the obvious in a rather unprecedented manner, which is they've called for an emergency MPC. They've realized that inflation is something which now needs to be tamed. Otherwise, it could have long-term and medium-term serious consequences. And they've come and rattled the market, I would say so, in terms of a rate hike. Now, the bond yields, immediately when the announcement came, remember, bond yields were already elevated. They've gone to a new high. Equity markets have tumbled completely down in terms of what is happening to the markets. The net impact, Sensex at the lowest point of the day, Bank Nifty at the lowest point of the day, bond yields at the highest point of the day. Bond yields will always sell off. That means there is nervousness in the bond market. So Reserve Bank of India, in a desperate measure, what was called as a denial earlier now is a sheer desperation to really normalize the economy and control inflation.
But look at the kind of impact that it's seeing. Just pre-policy, the yield was at 7.19 and now it's risen 28 basis points to 740, which is I think the highest since about 2019. And the equity markets, I think, your Nikunj phrase was absolutely right and apt here, because the Reserve Bank commentary, as behind the curve as it may be, which we will discuss with our experts shortly, we can just, quickly get them on board as well. 273 points lower. That's the kind of impact that you're seeing on a market which is going pretty quiet, a little bit weak although into the event, but we're now down 265 points. We've even breached that 16,800 mark on the Nifty, and let me not even talk about the breadth, because that's really bleeding. 167 F&O stocks are now in the red and well in the red. Even the few odd sectors which were holding out in the green pre-policy have also completely reversed trend. Cement, infrastructure, pharmaceuticals, real estate, banks, they're all taking a very, very hard knock. Let me also welcome on board then our experts, Manish Dangi, Bala Subramaniam. We've got a whole host of experts joining in on board, and also consulting editor Itina Maithili Bhusnurmat joining in. But Jeremy and Maithili, hi, good afternoon. A surprise meeting today. We weren't meant to meet, but the RBI governor has compelled us to. Manish Dangi, would you say that it's a move a little too late? RBI has been a little behind the curve in this move?
Yeah, there's too much noise here, but nonetheless, the RBI has been behind the curve for good 8-10 months that I have argued on our channel. But the bar was actually low in a sense. All it had to do was to make less errors than the big daddy, which is Fed. And, it's because Fed has pivoted now to rather very hawkish setup. US, and most probably they're going to go in for 50 basis point, if not more, rate hike this week. It's RBI had no choice. So it was a setup that, anyone long in the game would have actually anticipated. This is what happens by policymakers. They delay as much as they can, but then eventually fold the trade.
All right, now, Maithili, if I use the phrase that denial has become desperation now, or perhaps reality has dawned, something which should have happened 3 months ago is happening now, but it is happening in a more concentrated manner, which will shake the market. Will I be wrong?
Well, this is always bound to happen. If you have been behind the curve and you've been sleeping on the watch, as the RBI has been doing for more than a year now, I would say, not just 3 months, then when you act, you always have to slam the brakes down much faster than otherwise. The thing is, if you have, the governor spoke about being an optimist. I think it's important to be a realist, not just being an optimist. And this was something that was staring the RBI in the face for quite some time, as only one of the MPC members, Jayant Verma, had been arguing that there was absolutely no case for continuing to have an accommodative policy when prices have been rising so relentlessly as we've seen. Both the CPI as well as the WPI have been on the upward trajectory for a very long time. So this is something that is inevitable. Unfortunately, as I said, the RBI waited too long, and now when it had to act much faster than it would have been warranted had it acted earlier. The result problem, unfortunately, is that monetary policy acts with a long lag. So whether this will be able to curb the inflation in time, I'm not sure, because we've now reached the stage where inflation has actually become an obstruction to growth. Rather than the accommodative policy spurring growth and helping growth, the results of the easy monetary policy continuing for longer than warranted has actually become an obstruction to growth. Unfortunately, in all this, Nukund, I just feel a little sorry for the government, because when the LIC IPO is on, the timing in the LIC IPO, nothing could have been worse for the government than this. First of all, it came out too late, and now we have this. So I just cannot help thinking about LIC, the government, disinvestment, and how things could have been different if only the RBI had woken up in time.
Look at the bright side. This truly means merely that RBI is independent, right?
I'm not so sure about that, Nikunj. I think that its action all along was because its independence had not been asserted.
Surely broken the back of the market. I'm just rubbing my eyes in disbelief. We're at 16,789 now. It's a 300-point knock that the market has taken. Look at what's happening to Nifty Bank. That's getting battered and bruised, pretty much in line with Nifty, if not more, is where the Nifty Bank is. 592 points lower right now, 1.6% lower. And even financials, big boys like Reliance are falling about 3%. We always talked about as to how we were resilient. We were outperforming the global equity markets, and we talked about as to how the upside looks capped, but we haven't fallen a whole lot. I guess this is going to be that reason which is going to open the downside for us. But Bala, let's get in a market perspective as well. The market always knew that inflation was a problem. They knew that the RBI is going to move at some point. I'm surprised they already didn't price it in.
No, I think I should look at the market. I divided into two parts. One is the underlying cash market bond yields, but anyway, I've been trading about 7%. Second is we look at the OIS market, with reflection on the 1-year OIS or 5-year OIS, or the interest rate futures, have been discounting close to about 135, 140 basis point rate hike, and reflecting on the bond yields as well. If we have to take 1 year down, 1 year forward, down the line for 1 year, again the bond market have been actually estimating the series of rate hike would come. Therefore, having not hiked the interest rate in the last policy, and they just made a marginal announcement that they introduced SGF and then introduced that 40 basis points higher than the reverse repo rate from bond point of view of buying back bonds from the market. But now, having now delayed that point of time, now having have realized that inflation has been one concerning factor for the growth as well as the global economy. So they have actually fast-tracked the rate hike, which otherwise would have delayed it for another 1 or 2 more policy dates. And now they have realized it, which in my view is good, because earlier people used to make a comment that RBI is behind the curve, and that's something that's correcting it. But bond market point of view, in fact, I must tell you that though the bond yields have gone up about 20 basis points today, but otherwise there has been a significant expectation that the market has been building in, and that's the way the bond yields have been reflecting on the potential rate hike which RBI would have eventually make. And now that they have done it in a sudden way today, which I think the market will again take it, though the market reacted today, but at least it will be seen as something that RBI is now will be in a hiking cycle rather than being a competitive cycle.
Okay, I'm going to get one quick reaction from Shaktikanta just to get a sense as to where he feels that things will meet now. Shaktikanta, I'm going to not start with the beginning part. I'm going to start with the end part, where Reserve Bank of India governor endorses the fact that I am an optimist. It's like saying he's desperately trying to calm the markets down. Otherwise, governor will never come out and say, I remain optimistic and we will truly fight this war. The use of war for inflation and the tone of the choice of word of optimism. It just feels like he's nervous.
You're right. They still remain accommodative, although the focus is on withdrawal of accommodation. On the other hand, the surprise bazooka 40 basis point hike in the repo rate, which is actually good for banks, from the loans perspective of banks, because and transmission is likely to be faster this time because 40% of the floating rate loans is now linked to EBLR. So be that as it may, this is yet another more open mouth operations. So while on the one hand, hiking rates unexpectedly, but still saying that this is a signal that we probably will not have a steady path, a preset path, but will still be more or less data and evidence driven. So if oil comes down, if inflation begins to come down, etc., so then we'll probably moderate the pace of hikes that we now expect going forward into the rest of the year. So all of this builds up into that narrative that front load the rate hike cycle. Then let's see how growth pans out, how global growth, exports, trade, all of that happens. But remember, for them, the one major point that nobody is focusing on, that in the Q4 you had a 6% plus inflation, and for the next 2 quarters, probably the whole of the year, each quarter you'll get a 6% plus. As a result of which, 3 consecutive quarters for the MPC, they'll have to write a letter to Parliament explaining why this happens, which no central bank or an MPC wants to do. So these are the factors that probably front-loaded this kind of hike, which is even more stronger and more aggressive than what the Fed is likely to do. And that's probably what we can expect going forward. That try to calm yields. Now the question is from the bond market point of view, whether they will be with the CRR hike in the system, whether they will have the space now to try to do more OMOs to bring bond yields down.
Okay, Sunil Mehta, do you expect the transmission from banks to be very rapid in this time, which is that it's a matter of maximum 48 hours or 72 hours, the mail will hit my mailbox that my home loan rates have gone higher?
In fact, the bank rates are already linked to the external benchmark, as already said by Mr. Sugata, that there is an automatic linkage of a large portfolio of the banking system with the benchmark rate, and which is a repo rate. So that will be quickly passed on, so there won't be any gap into that. As regards increase in rate of interest impact and passing on to these, I think you must have seen some of the private lenders already announcing some rate hikes, because although repo rates were kept constant for quite some time, but the interest rate scenario was building up even in bond market. This was building up into the credit market also, and that was reflected in announcement of some of the banks even before this policy about hiking in their interest rate. So banking system was already anticipating a hike into the repo rate, and that was kept subdued maybe in the previous 2 policies, but that was reflecting in the market. And I think system was already prepared. So long as its impact on the banking industries, on one side, they will have some hit on the treasury side, because the rate of interest will go up, and the pricing of there will be issues about valuations of the treasury assets, and they will have to mark to market them. But on the other side, this will be passed on to the repo-linked advances, so they will be gaining. So that will be set off with that. So it won't have major impact on the banking industry.
Mr. Sabnavis, hi, afternoon. I'm guessing you would be in concurrence right now with Mr. Mehta, and I'm sure at BOB as well, the rates would be hiked up immediately.
Absolutely. I think that process did begin, but that was based more on the mismatches in the ALM. And today we are seeing that it's going to be more generic, is what I would tend to believe for the banking system. Because as what has been mentioned, once you benchmark to the repo rate, automatically 4 to 4.40 means that your lending rates will go up. But I think the important thing here is that the RBI has actually moved away from its earlier path of saying that we need to focus on growth. It seems to be very confident on growth, more confident rather on growth, rather than inflation. And I think it's the right path which has been taken. I wouldn't be uncharitable to say that RBI has been behind the curve. I think there was a certain stance which was taken for around 2 years, that until growth was durable, that would be the time when you would look at inflation. Inflation was high even last year. So we've had 6% plus inflation even last year, 2020, 21, 22. So I don't think it's been a new thing, but I think now it's quite rightly focusing now on inflation. The only thing I would look at it from the theoretical perspective is that there's been a shock element brought, because I think the market was expecting that in June, there would be an increase in the repo rate, and probably that would have been buffered in and may not have made a difference. So going by the theory of rational expectations, you need to shock the market, bring about something. Monetary policy will always have to have the shock element so that it works. Now, whether this will help to bring down inflation, to my mind, you cannot control global commodity prices, but to the extent that excess demand forces could be built up in the economy, especially at a time when we feel that growth is picking up, I think that would be quelled to a certain extent. So we should be prepared for more rate hikes is what my sense would be right now.
You know, the timing of it, I mean, tonight is when we're going to hear from the Fed as well. All expectation is that it's going to be a 50 bips hike in continuation with the 25, which has already happened, Shagata. So one is wondering that, you know, the RBI wouldn't be able to stop here. There is more in the offing by way of rate hikes.
You're right. You're right that more in the offing, probably yet another 25 in the June policy. But earlier we were expecting, because the RBI's FY24, next year's inflation forecast, is centered around about 5.2. So if you need to get the real repo rate up to at least that level, you will need at least 125 to 150 basis points, of which already we've got a 40 down. So I mean, I'm quite sure. I mean, at least they will take it up at least to that level, unless what I was saying earlier, that the situation normalizes. I'm very unlikely it will. But in the event that oil prices come back to about 80, 85, commodities prices come down, etc., and Indian growth begins to slow, which is the most important bit in this. Because remember, global trade, global growth, everything is likely to slow down this year. So if all of those things happen, then you are probably likely to see a more moderate pace of increases compared to what we are thinking.
And you know, I don't think, Nikunj, it stops really at just crude prices, right? Because as the RBI governor said in his own commentary, that the agri-inflation has also spiked up. So the consumer is now getting hurt.
No, all the commentary we've got from HUL, we heard from Titan today, we heard even from other FMCG companies, they are now feeling the pinch. Demand is down, margins under pressure. You can talk about the agrarian inflation coming back in the first leg, helping farmers. But there is a big change in terms of the approach, the wheel, the space at which we right now are trying to move in terms of policy normalizations. Manish Dange, you've been right in predicting the sequence of events, which is that crude will go higher, then commodity prices will start hurting us. Reserve Bank of India and other central banks will rush to course correct. That will lead to demand disruption, panic in the bond market, and perhaps a sell-off in the equity market. What is next in terms of a sequence of events? Like they say in the market, history does not repeat itself, but it rhymes, and history is rhyming again.
Yeah, it does always. And I mean, what's next is essentially from economy point of view, as I've been writing, warning that it's a short business cycle, Nikunj. And bulls must be forewarned that do not think of it as another 2003-8 or something like that. It's a very, very short business expansion that we've experienced. The peak is behind us in terms of growth acceleration. We're decelerating fairly quickly. And what we stare now is potentially a sort of analog of 2011 in play. I think everything would begin to slow. And what will not slow is inflation. So a sort of a very, very classic stagflationary setup is what I see ahead. It also, I have to weave in other parts of a market such as equity. You know, we've argued about the term of trade adjustment, Nikunj, that the large profit expansion that the firms had was at the cost of labor and small enterprises. That reversal is in play already, that you're beginning to see in this quarter. And what you sort of stare at now over next 6 to 12 months is substantial lowering of forecast of earnings and a classic, 8, 10, 12% kind of growth that Indian corporates have delivered over the last 8, 10 years, a rerun of that. So that's the big analog. I think, I think for a comparison's sake, Nikunj, I've written to you many times and openly also to many that it's a classic 2011 in play, wherein what you should, in terms of underwriting any risk, be it of rates, credit, or equity, think of it as a very short business cycle, not a longish one.
Right. Bala, are you there?
Yes, I'm there, Nikunj.
So Bala, now you don't have to agree with Manish, or Manish does not have to agree with you. You don't represent the same firm. So I'm just trying to take the point what Manish is saying, and there's logic in it, which is that if inflation does not come down, growth will come down. Growth will come down, estimates will come down. Estimates will come down, P multiple will come down. If everything comes down, then what should equity investors do, and why do you think markets will not come down?
I think the one of the things that, of course, the current situation definitely leads to some bit of uncertainty in the market. There is absolutely no doubt on that, and the impact of this in the company's earnings also is going to be reflecting in the next 1 or 2 quarters. Then, but having seen that, I think if one looks at the problem in the world and then the way I think India is positioned, definitely, of course, India is relatively better positioned compared to other economies in the world, whether it is Russia or China, or even some other global economies concerned. I think India is definitely better positioned. In that extent, I think even the way I think India is trying to drive back the growth, given the fact that large economy strength coming from rural economy, the government has been the bigger spender, unlike the private sector. And the private sector capex also now gradually is coming back, given the fact that the price levels are high and the profit margins are generally good. So therefore, the capex cycle also will begin. Therefore, this current cycle, while one may argue that yes, it will have an impact on the market, as Manish also is mentioning, that should be seen as a short cycle. And therefore, from an investor's point of view, you have to look at beyond the current cycle. At the same time, Reserve Bank company having now hiked the rate is basically recognizing the fact that yes, instead of letting the rates low for too long period of time and then suddenly do a significant rate hike and then create a panic in the market, at least now having set the ball rolling for the expectation of the future, at least the market to the extent will get priced in properly. And therefore, to the extent the future volatility could also get reduced given the fact now we know broadly the trend what the RBI will take and accordingly how companies also will get adjusted their balance sheet. The other point I think one has to maintain that unlike the past, the credit market is much more mature today, and people who have been borrowing in the market have reduced quite significantly, and most of the corporate balance sheets have got deleveraged significantly. Therefore, the ability to borrow and build the business with generating high ROE is also going to be quite significant as we move forward. Therefore, that is a significant improvement that has happened for the equity market, which never we have witnessed in the past. That's, I think, big thing that has happened for Nifty companies, or even beyond Nifty companies. The balance sheets are today a complete deleverage. Therefore, the impact on the companies on the basis of interest rate hike is going to be less. But of course, the business dynamics, taking it up on input costs going up and so on and so forth, that dynamic remains, which one has to live with that.
Absolutely. I just want to take a second before I take it across to Mr. Mehta. 16,682. We've even reached that 16,700 level on the index. And remember to think of it, last week, even with all that chop and churn in the global equity markets and back home, we managed to defend 17K. But 400 points lower. I mean, it's no mean joke here. Britannia, yes, is holding out, and so is ONGC. But look at the kind of whack that you're getting on Adani Ports. That's down 5.5%. Bajaj Finance down almost 5%. Bajaj Finserv down 4.5%. Hindalco down 4.5%. Titan down 4%. Divi's, IndusInd Bank, HDFC Bank, Asian Paints, Reliance, SBI down almost 3%, L&T down almost 3%. I can go on with the list of losers today and the quantum at which that they're falling. Shriram Transport Finance 7.25% gone. Apollo Hospitals, Voltas, Naukri down 7%. In fact, there are only 8 names in the entire F&O segment which are holding out in the green. And that too, there's Britannia, which is at the top of the pack with a 3.6% gain. But the rest of them are all down and out. It's a huge count of losers, 192 within the F&O universe. But Sunil Mehta, I saw you smirk when Nikunj was asking Manish Dangi as to how the script is going to play out next. What happens from here onwards? I mean, do we now rework our growth, inflation, and of course, for some of us, market projections as well?
No, I don't think it's a very long-term view we can take on today's development, because ultimately whatsoever has come up today is basically the base inflation data available for March, which is in the range of 7%, hike in petroleum prices, then shortage of supply from the Ukraine of sunflower oil and edible oils, and that has pushed up the prices of the agricultural commodities. But my view is India has got a inherent strength, a lot of inherent strength. the largest younger generation to consume and produce. And the advantage is any increase in prices of agriculture commodities brings down some buoyancy into the ancillary sectors, because agriculture, the large population is dependent on that sector. And if the income available at their disposal goes up because of the increase in prices, that comes for consumption of the other industrial and the other services, that brings it to the improves the performance of the ancillary things. I don't think this is going to make any major difference into the economy of our country. As regards building of the prices, like repo rate is one indicative prices, but market moves as per the demand and supply chain constraints, and accordingly the prices are moving, and that decides about the viability of each and individual sector. So long as the availability of market and the future potential for growth and the shift of, as rightly stated by governors, are also that some of the largest economies are having issues of pandemic once again, and they are going for lockdowns. That may provide a greater window to the Indian economy for providing a supply window for the world for a lot of the activities. So we have a great scope for growing into the export sector, which can compensate about this thing. And once that picks up, I think the growth may not get impacted. So growth is one sector where I'm totally aligned with the statement of the governor that despite increase in inflation, the growth we are able to retain because of the various issues. As regards margin, yes, it will impact some of the sectors where the major contributing raw materials prices have gone up because of the geopolitical issues, and there the margins may come under pressure. But I don't think that situation is going to prolong for a very long time, because every problem has a solution. It may take time. Maybe it has already taken more than 2 months now. A stage has come where the geopolitical issues may get resolved, and when they get resolved, then automatically the markets will cool down, and the inflation may also come within the manageable range. So I'm a bit optimistic about it, that the country has a scope to navigate with the market pressures right now.
Shaktikanta, like we were discussing, it doesn't seem that the RBI is done with. I mean, what happens to inflation from here is anyone's guess, but it seems like it is going to continue to be elevated. We're already moving behind the Fed in that sense. And, tonight, I don't know, the expectation is of another 50 bips hike. Who knows what could be the quantum? But what happens from here onwards? Do you rework your growth, inflation projections?
I think this system needs to wait for some more time. It's too early to revise all the projections because, as everybody said, it's a small cycle, and the geopolitical issues may get resolution at a shorter period of time. So it's no need to go for a overall long-term projections, but definitely some revenues and cash flows need to be worked out based on this changing the interest rate scenarios and the changing factor, because every company will have some impact on the pricing of their raw material, on the pricing. So revenue generation issues definitely need to be addressed, but I don't think there is a need for reworking of the entire entire growth projections.
Right, Sunil Mehta, I got that. Actually, my question was for Shaktikanta. Shaktikanta, you go on that one.
No, I agree with Mr. Mehta, what he said, but obviously, I mean, there will be an impact. I mean, that's what monetary policy is designed to do, right? I mean, if you're in a hike cycle, the monetary policy is designed to slow the system down. So we were anyway, I mean, Reserve Bank of India, I don't know what led to IMF's 8.2% growth projection for India. I have no idea. But Reserve Bank itself had been down to 7.2. We were at around about the same point. So now, obviously, I mean, the idea, just like the Fed is probably trying to do, is to actually force the recession down into the US economy, because, I mean, it's so super hot, the labor markets particularly. So obviously, I mean, there is the design of this policy hike is to slow the system down. So obviously, there is a level. Remember that you cannot have 2.5 years of 5.5% core inflation unless there is an element of aggregate demand in the system. So to be able to cool that core inflation down, which is now likely to be closer to 6%, so to close that down, you have to slow growth down. So that is what it's supposed to be. But how long and through what channels that comes in? So obviously, one part is the stock market, the equity markets, which begins to come to take down the wealth effect on aggregate demand and consumption. So that's one. So asset market inflation is likely to come down a little bit. But beyond that, in terms of the channels through which the real economy is likely to slow down, those would need to be monitored very closely. Remember, again, finally, aggregate demand in India is probably coming in from the top 1, 2, 3 deciles of the population. So it's not spread across the population. And for those deciles, despite an increase in interest rates, home loan rates, auto loan rates, etc., the marginal propensity to consume is not going to be affected to any significant extent. So that demand, the demand in that particular segment, the top in income level households, that will need to be moderated for the overall levels of growth to come down and actually achieve some of the objectives of monetary policy.
Right. Manish Tangi, I know you were always, off late rather, you've been a fan of actually buying farmhouses. But considering you're an equity as well as a debt market watcher and economy at large, just wanted to understand, with this kind of a commentary, an out-of-turn move from the RBI, one can continue to debate whether it's behind the curve or whatever. But the way the market is panicking right now, you're seeing some crucial levels getting broken on the Nifty. We're down over 400 points. It's 2.5% slash coming in on the index alone. And I'm not even talking about individual stocks here. What's in it for an equity market watcher? Because you knew, looking at the commentary from some of the consumption companies, you knew that inflation was a grave problem, but here now it's hitting you hard because interest rates are going to go higher. So just everything then in reality, and every loan that you've actually picked up is also going to go more expensive. Cost of money as well is going to go up. So what happens from here for an equity market watcher?
Sort of skip the both bond and equity, so it was somewhat metaphoric, okay, as to what to do with money. But nonetheless, the joke in West is that this time it's different. And every time I hear an Indian analyst on TV, the joke is that India is different. And the truth, of course, is revealed at sort of reasonable frequency that India is no different. So we are in a setup where interest rates are going to sort of be lifted quite dramatically. Even markets as of right now are pricing near 300 basis point incremental tightening in India. So the terminal repo rate is going to get to somewhere between 730 to 760, 770, and that's going to happen over the next 2 years. In that sort of a tightening cycle, we also are staring at sort of a huge amount of borrowing from government, not of this sort, which has never happened in the past. So the underlying, discount factor that I've argued on your channel for last 6-8 months is going to go up. We were at 6 months ago, 10-year bond was at 6%. And, I sort of posited that, it's going to be closer to 8 than 6 in about a year's time. And we're already there. So from an equity market point of view, I think what people have to revisit, not just the growth outlook that I've sort of enumerated, which is pretty dim in my view, but also the discount factor in India, is no more 6 as a baseline. It's likely to be 8. If 7.5 is the repo rate, you're going to get 10-year US India Treasury at 8. And therefore, you cannot sort of sell equity in India at an expected yield of 10%. It has to go to 12. And that would mean that you'll have to sort of revise the estimates of your Nifty and Sensex and mid cap and small cap over the next 1 or 2 years. And notwithstanding that, of course, there are other forces at play, as right? Because of the margin compression, the expected EPS growth of most indices are going to be like 10-12% lower than what you were anticipating 3-4 months ago, which means that you have a double whammy. One, that the discount yields are rising precisely when actually the earning expectations are actually falling. So that's the argument that I've had, that you're going to get to in this narrow lane where you will have little space to exit.
On that grim note, Manish Tangi, great to have you on the show as always. Sunil Mehta, pleasure chatting with you. And I'd like to also thank Shogata Bhattacharya too for taking the time out and analyzing this out-of-turn meet that all of us had, thanks to the RBI today. We haven't taken a break in a long while. We'll do that shortly. By the way, we are down 383 points now, so just circling around that 16,700 print for the Nifty. And yes, all sectors are bleeding right now, more so for the banks and the kind of reaction that they've seen as soon as the policy came out. Autos, cap goods, cement, infrastructure, media. There's not even one sector which is spared. We'll take a very quick break. When we come back, we'll continue mapping the last half an hour of trade this afternoon.